The FOMC voted to leave the Fed funds rate unchanged at their July meeting. That said, the consensus views of the committee and additional colour provided by Chair Powell in the press conference made clear the FOMC is willing to cut when the balance of risks warranted. In the statement, guidance on inflation was restricted to a simple present tense phrase: inflation remains somewhat elevated. Then, at the press conference, Chair Powell provided a little more information, noting it was currently appropriate for monetary policy to remain modestly restrictive as annual inflation remains above the 2% target, excluding the impact of tariffs, which is nascent. At the time of the meeting, a deterioration in the labour market was a potential risk to watch out for, not an immediate concern, with the unemployment rate having essentially been unchanged over the past year. 2 days later, however, the July employment report challenged this view. Not only did non-farm payrolls employment disappoint in July at 73,000, but May and June's gains were revised down by an unusually large 258,000, taking the 3-month average change in non-farm payroll employment from 150,000 to just 35,000. Household survey employment has been weaker still of late, averaging a monthly decline of 132,000 per month over the 6 months to July. If the participation rate had not declined by 0.4 percentage points since January, the unemployment rate would now be around 4.6%, not the 4.2% reported in July. Considering household demand growth almost stalled in the first half of 2025, government spending was flat and a tariff-induced surge in business investment in the 3 months to March proved fleeting. The US labour market is likely to weaken further in the second half of 2025 and remain soft in early 2026. Ahead then, the FOMC seemed likely to not only have to contend with upside risk to inflation, but also a real-time threat to employment and activity growth. Before the FOMC's next meeting, we will receive another read on the US labour market. Unless that release counters July's narrative, the FOMC is likely to cut by 25 basis points in September. The more material question is what happens from the December quarter on. The market believes the US inflation concerns are simply a transitory tariff shock which can be looked through. We are less convinced, expecting structural capacity constraints to continue putting upward pressure on inflation through 2026 and into 2027. If inflation does quickly abate to the 2% target, the almost 130 basis points of easing the bond market has priced to end 2026 is possible, taking the Fed funds rate to a broadly neutral policy setting. But if our read on capacity and inflation is instead closer to reality, the FOMC is unlikely to be able to justify cutting much more than 50 basis points from here. That is one more cut beyond the September meeting, even with a further modest deterioration in the unemployment rate to near 4.5%. Obviously, the labour market deterioration could accelerate, forcing the FOMC's hand. If the unemployment rate moves up towards or above 5%, additional easing will be warranted without delay. Currently, there is not enough in the data flow to suggest this is likely. That said, until the July employment report, labour demand and supply were believed to be in balance. The past few years, US inflation has been the data point to watch. From now on, however, the employment report will be participants' focus. Expect volatility and a downward skew to the risks. We'll keep you up to date on the outcomes and the implications. We'll see you next time.
The content of this recording is informational and of general nature only, and is not intended to constitute a research report or reflect any recommendation or financial advice. It has been prepared without taking into account your objectives, financial situation, or needs, and investment decisions should not be based on it. You should obtain your own independent advice before proceeding with any investment decision. Whilst every effort has been taken to ensure that the contents are correct and any opinions, forecasts, conclusions are reasonably held based on information at the date of recording, Westpac does not make any representation or warranty as to the accuracy or completeness of the statements or information contained in this recording, and any liability therefore is expressly disclaimed to the extent permitted by law. None of the material included in this recording should be copied, published, or reproduced in whole or in part without the prior written permission of Westpac.